Welcome to Accelerate Your Wealth, a podcast by Rebecca Robertson, founder and director of Evolution Financial Planning. We hope you enjoy the show, and please feel free to leave us a review. It really does help. Feel free to connect with us on Facebook, LinkedIn and Instagram, or head over to www.rebeccarobertson.co.uk, or our sponsor, Evolution Financial Planning, for regulated advice on www.evolutionfinancialplanning.co.uk/podcast.
Welcome, Jennie.
Hello.
Hello. I've worked with Jennie for 9 years. So Jennie worked, to start off with, you did protection and wills, right? Just to start.
That's correct, yes.
Yeah. And then she started doing, as well as, I was doing a lot of mortgages back then. That's probably close to 2015. And you started doing administration. So you looked after all of my mortgage applications and you became very good at it. So you started then take your CMAP exams, and then you became a qualified mortgage broker. How long ago was that?
A long time ago, 2015, 16.
Yeah, I think it was around 16.
Something like that.
Long time. So you've sort of, you've I'd probably say, what, 8 years now doing mortgages or something like that? Maybe not 7 years doing mortgages?
Roughly, yeah.
Okay.
A lifetime ago, it feels like.
Yeah. I mean, I probably haven't done mortgages for that long, because Jennie is my mortgage broker. She works with myself as a regulated I'm a financial advisor. Jennie's a mortgage advisor under Evolution Financial Planning, which is a regulated company. Obviously, this podcast is just us chatting. We're not giving regulated advice at all. So you do need to get one-to-one bespoke advice from a qualified mortgage advisor to really understand your personal circumstances. But the purpose of today's podcast is to share Jennie's brain and what's going on in the mortgage market right now. Because we read about it, we hear about it, but what's really what's happening under the bonnet, what's really happening in day-to-day business. And I thought I'd invite Jennie on. So Jennie also does protection, so things like mortgage protection and business insurances around, like, for example, the equivalent of death in service of work. If you work for a bit, if you've got a business, you can take out your own equivalent of death in service, and also things like income protection, which I do as well. And also Jennie also, which I don't any longer, do wills. So she's also a lovely will writer. And I would say Jennie's skill is she is very direct, which I appreciate personally, and I think clients do too. You don't really, in these kind of circumstances, want to be messed about and told one thing and then another. But with that, I would say that she's very detailed and direct. So she won't give you an answer unless she knows she's right. So unless she knows exactly about all the detail, she won't really give you an answer. Now that can be to a benefit, and I'd rather clients not be messed about and not told one thing and then told another.
Definitely. Under promise, over deliver, isn't it?
Yeah. Yeah. So Jennie's going to share a little bit about what's been going on. Do you think this year's been unusual, Jen?
It has, definitely, and it's not finished. I mean, it's a difficult one, because when, for example, I've got a lot of clients who said to me, right, what do we do? What is it going to be like in 2 years or 5 year time? I haven't got a crystal ball, I can't tell you. And if anything, this year has showed us that you can't plan what's going to happen in a few years' time. So I always think, do for the now, don't think about later, because everything can change. Last year, everybody was saying, yes, the rates are going to go back down this year. And I was like, well, it's not guaranteed. No one really knows, with inflation, with everything that's going on at the moment, with everything else around us, So yeah, it's definitely this year, since more so over the past few months, since the last couple of Bank of England increase, it's just gone a bit crazy. We've had a bit of what I'm gonna say, if you're not ready to proceed now, I wouldn't bother looking for a mortgage, because tomorrow it might all be different. We don't know.
But a lot of people, and I do agree with you, because when you're submitting a mortgage application, we should clarify this. as you can imagine, you need to know an awful lot of information. So as a financial advisor, I need to give people the right advice, but it's not like if I say, okay, we're going to do a pension and we're going to set up that pension, I don't actually need a lot of documentation. I need to confirm under, make sure the client is who they say they are. I need to make sure from a money laundering perspective that the money is, what we class as good, clean money. But in terms of the actual application and setting it up, yes, we have to make sure it's right for the client, but all we're doing is taking their name, their address, their date of birth, and a few other basic details and applying that to, let's say, Aviva and submitting an application. And we would have that basic information. You can have that when you fill out an inquiry form, half of it. Whereas with a mortgage, you need to even, at one point, I remember like when affordability came into place years ago, and there was talk about, knowing when you go out for dinner, what type of steak you have, like the detail of what affordability people wanted. And it's not quite as detailed as what they thought it was going to be like, but it's people, you need to know a lot, right, Jen, to do a mortgage application. You do need to understand the whole thing. So you're saying, if you might want to know what your rates are going to be in like 3 or 4 months time, but until it's actually time to do this, there's no point.
Well, the thing is, you can lock in a rate now. So if your mortgage is due to end within the next 6 months, for example, we can quite easily lock in a rate. Obviously, we can do the application, submit it to not start up until the current rate runs out. So that there is the option there. Well, I would say if your remortgage is due within the next 6 months, let's have a look at it now, because you can save that rate. As long as the application is fully submitted, obviously, you can say, right, okay.
And that applies to most lenders, right? Does that's not just 1 or 2 lenders that do that? Is that all lenders?
Most of them. So some of them will say 3 months, but usually, it is up to 6 months. So an offer is valid 6 months. So you can, there's no wrong.
If someone's worried about interest rates in the future, that could be a good way to avoid that stress, right? They could lock in rates now.
Definitely. That's what I normally do. So all my clients are contacted 6 months before. Obviously, some of them are not going to do anything until 5 months before, but then I chase them, I follow up with them to say, right, we need to do this now. I worry a lot about my clients' rate, and obviously I want them to get the best rate. So if we manage to save a rate now, and if in 2 months before, 3 months before, the rate goes down, I always go back to them and say, right, let's see if we can switch rate and to see if it's because it's reduced now, which is the best way of doing it. And if the rates increase, we're not losing out on anything. We've already locked in a rate anyway. So I've done that a few times over the past couple of years, because obviously all the rates have been going up and down and up and down. Well, the lenders do increase the rates above what it should be, because obviously they plan and don't want to lose out. But some of the rates do come down after a while, not by much, mind you, but it's still, it can happen.
So what do people need to be, okay, so their rate might not be maturing. So we're now we're recording this on the 5th of June. This will go out next week. So let's say it's going to be mid-June. So we've got July, August, September, October, November, December. So their rate might be coming up at any point this year. Then they obviously can approach you or a broker. You might have your own local broker you've moved before. We're not saying exclusively use us, but hey, come and see us.
Of course.
What would they need to make that as like to be prepared for it? So let's just say, okay, well, they don't want to necessarily do it right now. They'll wait a few weeks, see how rates land now, because they're changing a lot. Or they might say, actually, oh, panic, are they going to go up? Let's go and secure these rates now. What do they need to be ready?
Right, so they need to gather all the documents. So sometimes clients think, right, that's a lot of documents, but the way I work, I might ask more documents, that's what's required, but that helps me to avoid in contacting them every 5 minutes. What's this for? What's that for? So as a standard, we'll need bank statements of 3 months, tax calculation, tax year overview, ideally latest 22, 23, if that's been done. If their income is higher, we'll need ID, so passport, driving license. We'll need payslips if they're employed, 3 months payslips. We'll need proof of address, so a bill, council tax or utility bill. And then obviously any extra documents depending on their circumstances. So if they're getting benefits, we'll need the awards for that. If they are from another country, we'll potentially need a residency card and visa that goes with that, and everything else, you know, which might be required. So as a basic, this is what we'll need, but obviously there is all these extra little bits we might potentially need as well.
Yeah, and they might have like 2 or 3 different bank accounts with money going into different places, right? So we've got, my husband's got an account, I've got an account, we both get paid, but our direct debits come out of another joint account. So you might end up needing 3 lots of bank statements from different, and obviously if they're self-employed, they might have income, or a limited company, they might have then a limited company business account, and you obviously then would require 3 months. Would you require 3 months bank statements for the business as well?
Yeah, everything. The more I get, the better it is at the end of the day, because it allows me to look at their circumstances overall and make a decision. Obviously, if I've got documents missing, I can't make a decision without having a look at every single bits of documents. So it
saves time, right? Because that way, if you submit the application, you know that the lender's going to ask you for certain things, and you don't know if they're going to ask, I think I asked for that joint account bank statement, for example. And then it goes to the underwriter, they're looking at the case, they haven't got it, or they ask you for it, and it takes you another 3 or 4 days to get it back to them. That's another delay. But sometimes if you can get it in quickly enough and they ask for it, you don't always give them everything they need straight away, do you, Jen?
No.
Sometimes you don't give them everything. You give them what they ask for. And then if they ask for something extra and you've got it quickly, they will then pick it up often a lot quicker because it's fresh in their brain. Rather than it going back into like the end of the queue and sort of the queue start it speeds up the process so much. And we should talk about lenders a little bit. So what are they like to deal with at the moment in terms of application processes?
So some of them are good, some of them not so good. I won't mention any names, but usually, I mean, I've formed a kind of relationship with some of the underwriters and BDMs. So certain lenders are really good because you can just pick up the phone, call the BDM, say, I need help. Can you support me? Yes, no problem. And it makes it so much easier for me doing my job if I've got that relationship. Same for underwriters. Some of them will call you. They say, right, we're missing, like you just said, bits of document. Can you send that out? I'm like, yeah, straight away. And then you can work on it to avoid delays. And then obviously, hopefully, issue an offer after they've checked everything.
And I mean, what's your average time to turn around from application to offer, do you think?
On a good case, average case, or a worst case?
Average, between the two.
Okay, about, I would say 3 weeks. Obviously, everything that's going on, roughly about 3 weeks. Obviously, some of them are faster and some of them are longer.
Depends if you need a valuation though, right? Because if they do a desktop valuation, which is where they do an assumptive valuation, that'd be much quicker.
Yes. So not all of them do that. Obviously, with the way the housing market's going at the moment, although I haven't found that the house pricing has gone down too much, but still there's a bit of a difference. So if the lender decide, we'll go and check out this property, then it will take a bit longer because the lender don't actually do the valuation themselves. They appoint a company to do it for them. So depending on how much work that company's has got, then it might take slightly longer.
Yeah, and it depends on the area as well, doesn't it? Because some areas are busier than others, etc. And they might have, like, summer holidays, it will slow down and get more difficult because then people are on holiday, and so you're a lot of things are out of your control. What would you say is the benefit going to a broker or intermediary like you've just described, where you're dealing with, we're independent. Some are what we class whole of market. So I'll explain the difference. Independent means that you're not restricted in any way, so you can go to anybody. I'm talking to Jen like Jen knows this. I'm obviously explaining. But whole of market, you can call yourself whole of market, but actually that means you can work off at quite a restrictive panel, or you might have a lender panel that's quite healthy. You might have like 25, 30 lenders on it, which, if you're dealing with all the, what would you say are the top 10 lenders, Jen? Halifax, Santander, Coventry,
HSBC,
Acord,
Barclays,
At 6, yeah. I've always avoided them. I've been like 23 years in financial services and I avoid Barclays.
Oh, yeah, no comments.
Yeah. This is my podcast. I don't care if I get in trouble. That would be 7, 8, and 9 and 10 after that.
Principality, you've got a few of them have been very good. I mean, I've gone off track a bit and not used the standard. Would you get
Nationwide? I used to use
Nationwide, NatWest, yeah.
NatWest, yeah.
NatWest.
One more.
Oh, did I say I called?
Yes.
BM.
Yeah, Birmingham Shires, old school, yeah. Definitely. Yeah, so whereas if you've got those sort of tech lenders, then if you are on a panel, then you can always check with that whole of market broker how big their panel is and who it involves.
Yeah.
Because unless you get the odd really obscure one, like I'm buying a second house, going to rent it out for my nan to live in, kind of weird, like slightly more unusual, and then you might need to go off piece. Or I started my business and I've only got 1 year's accounts. Like they will take different kind of lenders, which is why if you go to a broker, you're better off, because you're not having to have all the credit scores and give all the information over to several different companies. You're giving it obviously to one person, which will save you time. Jen, do you hear from clients these days how existing, we're talking about lenders, but have you found what are clients saying about their own lenders these days? Are they sort of quite good at servicing their existing clients when it comes to like remortgaging and giving new deals? How are they looking after them?
So some of them are, some of them not so good, because obviously between the time you got your mortgage and the time you need to remortgage, your circumstances might have changed slightly. And obviously at the moment, the criteria is tightened up. So even if you need to remortgage and you go to your lender, you might not potentially get the rate or the mortgage that you want. So you've got to be very mindful. So it's always worth, if somebody's with somebody with a current mortgage, I always tell them, go and ask them. And if you don't want to ask them or you can't, let me do it for you, because I can do that as well. As long as I've got authority, I can access those deals and tell you, right, okay, I think we should either stick with them or move to someone else, which, you know, sometimes. At the moment, there was some good rates, but obviously now it might be better to ditch and go to another lender, because the main 10
aren't they?
Might not have the best rates at the moment. I was looking at this morning. Yeah, it's funny. Some of the lenders are just from, you know, smaller lenders are popping up at the top at the moment, which is surprising. But, you know, obviously this is today's rate. It might be different tomorrow. Who knows?
Yeah, who knows? Yeah, exactly. I think, well, what happened last week is a lot of the big boys have pulled their rates, right? Because they're just what they wanted. And that's sort of what happened with, when was it? Was it Liz Truss last year where they pulled a load of rates?
It was, yeah.
A massive scare in the market because there was hardly any, the lending drop because there wasn't enough. And they do this. This is not unusual. This has happened for years, where they pull the rates and they're then trying to figure it out. Okay, what's our next move? Because they don't really want to set the rates and then have to change them again a week later. They don't really want to do that, and they have tranches of so many billion that they will lend at a certain amount. So they want that tranche to sort of to you know, that's how they function and how they run their business. So if the clients, let's just say they're with an existing lender, like one of the 10 we mentioned, Halifax, Nationwide, HSBC, NatWest, Santander, whoever. Yeah. And they know that their mortgage is coming up maybe in like 4 or 5 months' time. They've not had a letter or been told anything yet. Their circumstances haven't changed in the last 2 to 5 years. What should they ordinarily, would they just normally ring up their lender? Are they able to do a lot of stuff? I know a lot of lenders now, because of regulation, they don't give advice. You still have to then go.
That's correct.
So I found this with Santander, who I bank with. They wouldn't talk to me over the phone. They'd only see me in a branch, and like they'd only see me in a particular branch, which was miles away, because that was the only branch they had an advisor. It was not something to do with mortgages, obviously, because I could figure that out myself, and I have Jen. It's like, and they could only see me like 2 o'clock on a Friday. It was like, is that still happening?
Yeah, it is. So if you want to talk about your current mortgage with your current lender, you call them. You might not have an appointment straight away. It might be within 3-4 weeks time. By then the rates might have changed, and like you said, they're not going to give you any advice. You need to see you need to speak to somebody specifically about the mortgage, not when you first call up. So it'll be an advisor there that will obviously say, right, okay, I will speak to you in 3-4 weeks. Let's book this appointment. It might not be face-to-face, mind you, now, but still, it can take quite a while, where in the meantime, all the rates could be different. So it's always worth contacting a broker or me and ask, right, okay, can you have a look at that, see what the rate could look like? I give you authority to check the account, and we can do it straight away.
So if you've got time and you don't want to speak to another broker, you just want to go to your existing lender, which is fine if that's what you want to do, then do it well in advance, right? And be organised and plan ahead, definitely. So let's come back to mortgage interest rates. So there's been a lot of stuff in the news recently. I've been sending you articles and I've forgotten half of it, if I'm honest, because it's Monday morning and I went out at the weekend. My brain's slightly smudged. But one, I actually went out for a change. It never happens. But there was one that I thought was interesting. It only came out, when did I send this to you? I think it was only on Friday. London to be hit, this was the Evening Standard, London to be hit by a 1.4 billion mortgage time bomb. Interest rates hike will mean homeowners face bigger bills as cheap fixed deals expire. So this is basically saying that 1.4 billion mortgage deals over the next 3 years are going to be forced to replace cheap fixed deals with far more expensive loans. Well, I think everyone knows this is what's coming. And I remember back when I was doing mortgages, which was about 5 or 6 years ago, and people were taking out fixed rates really, really, really low and overextending themselves. And we have to, on our illustrations, it says, if mortgage interest rates went up by 1%, this is how much it will cost you. And I used to say to clients, okay, well, if it went up to 1%, is that comfortable? And they go, oh, yeah, I could probably cope with that. I said, what if that was 2 or 3 times that? Could you cope with that? Because there was a point where interest rates were 15%. Oh, no, I couldn't afford 15%, but I could probably go to like 2 or 3%. I'm like, but it could quite easily go to 5%. And look at where we are now, right? With the bank base rate. So are you finding that, do you think people are going to be like quite short over this year? Do you think people are going to start struggling?
It is going to be difficult. I mean, obviously, I haven't got a crystal ball, so I can't really say. But I think with careful planning, if you plan early, certainly I would, if you can look at your mortgage now, I would definitely do it. If you're on a variable, because some of them, it's funny, it's a couple of clients spoken to are currently on the variable, and I'm thinking, well, let's have a look and fix it now if we can, look for a suitable mortgage. But some of them can't move their mortgage. It's a difficult time for sure. But I mean, the Bank of England, they're predicting that it might go up again in June on the 22nd. And then by next year, I think if they said it'll be about 5.5%. So the way the lenders work on that is they will pull out all their current product, put new products out that are way more, way higher than what, the prediction is. And then they realize that a few weeks later, and then the products come down again slightly. So it's a bit of up and down. So if you can look at your mortgage now, have a look, because obviously no one knows what's going to happen, but it's predicted to go up with inflation. Everything, it's not just mortgages, but everything, isn't it? So plan a bit. If you can put a bit aside every month, do it as well. If you can pay a chunk of your mortgage to reduce the mortgage, do it as well. I know it might not be easy for some people, I understand that. So, but if you can, reduce your mortgage and reduce the loan to value, because the lower the loan to value, the better the rate as well, the higher the loan to value.
And that's something to consider, right? So if you had a client who was, I don't know, let's try and think of some figures here.
I've got figures here if you want.
Okay, give me some examples.
Right. Okay. So this is up to today's date. So tomorrow it could all be different.
It probably will.
So this one is on a residential. So it's one of my clients due to remortgage beginning of next year. So 2 years ago, we got a mortgage. It was a 2-year fix. It was a resi, 30-year term.
That's residential for those that aren't in the jargon.
Sorry. Yeah. So the rate back then was 1.19, right?
Lovely.
The monthly payments was, it's currently £843 on the repayment.
Okay, how much was that for, sorry?
255,000.
Okay, over how long?
30 years.
30 years. Okay, yeah.
It was a 44 loan to value, so the difference between the purchase price and the current mortgage. So
I mean, that's nothing, isn't it? Like that, you wouldn't be paying that in rent. Like that's really low. You would be. What's that, like a 2 or 3 bed somewhere? Like what would you be paying in rent? Probably more like 1,400, like twice that.
Yeah, no, definitely. Well, yeah, it's in London, so yeah, a bit more than that. What the client did, they decided to put as much deposit down as they could to get a lower mortgage, so it was the best move for them, definitely. So you ready for this? So today's date, 2-year fix is now 4.19. So their monthly repayments are going to go up to £1,245 roughly.
Wow, so that's a 28-year term now.
Yeah,
we've got 28 years left still, but probably only paid off. Usually it's about an average of 8%, and it's the way the repayment mortgages work. You actually don't pay off that much in that 30-year period. You probably take you about 12 years before you start seeing big chunks come off it. It's almost like a front loading the way it pulls down, and it's in the latter 10 years you see big chunks come off. So Jennie Ron was talking about loan to value. So what loan to value product is that, Jen? Is it the same loan to value as what it was 2 years ago?
So I've kept it, obviously I did a quick search on it, so I kept it, it's 44 loan to value. So that I've used the current amount, so to keep it simpler.
44%.
Yeah.
Okay, so that's quite low. So most tranches go up to 60%, don't they? So every lender will be, you can tell me if this has changed, because this is like...
No, that's correct.
Old school was up to about maybe 55-60%. Most lenders will keep the rate the same. You don't any benefit if you've got a 20%, 30%, 40%, 50%. It's only once you start dipping into up to 65, and then the 70, 75, 80, 85, 90, or if you're lucky 95, that's when the rate starts to jump up. Correct. So in that example, if she paid 10 grand off, it wouldn't make any difference to the rate, but obviously it could make a difference to the monthly payments.
That's correct.
Because they're not borrowing as much.
Yeah.
Would you be saying to someone like that, if they said, I really can't afford it, I'm going to really struggle, would you suggest putting the mortgage term back out again up to a 30 or 35 year if they had to?
Potentially, yes, although I would want to see all the documents and make a decision based on the information that I've got, because sometimes, I can't do it. But when we look in, for example, if you're going to spend £500 every month going out, I would potentially tell you, well, ideally you want to be mortgage free, so stop going out, not in so many words maybe, but stop going out, spending £500 on clothes and going out. Try to put a bit aside, and when we remortgage, let's reduce this mortgage, even if it's a few thousand. And also you got to remember, most lenders will allow 10% a year. So if you can manage to put aside and pay 10% of your mortgage yearly, then that will reduce the mortgage come remortgage as well. That makes quite a big
difference. That if you start doing that now, and that would be the situation where, unfortunately, the society that we live in, we're taught to overspend, basically. And I know this doesn't help people who have taken out big mortgages. It doesn't really help the fact that, usually we've got couples that are both having to work now because they need it to buy the bigger, get a nice enough house because property prices are so high. Bear with me. I'm not going to bother editing this. I've got to let the dog in. One sec. He won't stop. Come on, you. I'll get back to mine. I don't know if you can hear it on the mic, but it's like this little tapping, and he's just such an old boy now. I know. Hello. Yes, he's back. What was I saying? Yeah. So, I used to say to people, try and get yourself in a situation where, I see this on the school run, the size of the cars that people have these days. I get a rust bucket and run it down to the ground. I'm not really bothered about cars, but I do spend what I spend on horses. Would make people cry. So it's all relative, right? I'm not judging.
Definitely.
But if you're going to go out and spend, you've got a car loan that's £500 or £600 a month, you might just have to make some bigger other financial decisions, right? Because paying that mortgage over a longer period of time, it's going to you're going to be charged more interest. So it's not actually good financial advice to do. You'd be better off selling the car that's probably held value more than it ever has done. Cars are holding their value, if you bought a good one, more than they ever have done, unless you bought brand new and you've only bought it like 6 months ago and you paid all the tax on it, unless you did that. But you'd be set to sell that car, downgrade the car, and actually have that as like whatever the extra is on the mortgage that you now can't afford, that you use that money to sort of like give you an extra income over the next few years. And you don't drive as flash a car. And I know that might sound just trying to give like an example where you just might have to make adjustments.
Yeah, no, definitely. I mean, you know, if you save, I know people use Starbucks as a good example. If you buy a coffee at down Starbucks daily, then that's something you won't want to cut back on, and just get yourself a coffee at home. There's all these little things that I'll be looking at and talk with the clients. Obviously, you know, at the end of the day, the ultimate decision is theirs. Like I said to them, you know, I'm just here to support you and guide you. But at the end of the day, if you tomorrow you tell me, I don't care, I want to extend the mortgage, I'll be like, okay, fine. Although you've been made aware that potentially we could look at different solutions, which is fine, you know, but as long as you know, then that's okay by me. So yeah.
I mean, I feel like we could go off on lots of different tangents. I want to talk about debt consolidation.
Yeah.
Before I do that, I just want to come back to about interest rates, and then we sort of can finish that side of the subject before we move on to debt consolidation and a little bit more about criteria. And if you've got maybe some other examples to share, that'd be great. If you haven't, that's fine. But there was a piece in the Sky News. This was Friday the 26th of May. Mortgage products have been pulled from the market, which is what you've been saying. This was last week. So you were feeling it, and it was happening in real life last week, and then the Sky News reported it on Friday. Pulled from the market is paying mini budget era interest rates on bonds as the market expects rates to go higher than previously thought. So what was going on last week is the bond market is having a bit of turmoil at the moment, and that is what's causing a little bit of not like just a lack of confidence, I guess. And then what also happened last week is inflation was reported down overall, and for household bills it was down, but the core inflation, which is things like restaurants, eating out, hotels, that kind of stuff, was actually higher, and that spooked the market a little bit, because everyone sort of predicts what's going to happen. Although we talk about you can never predict it, you haven't got a crystal ball, there's no point predicting it. That's actually what happens in the city constantly when it comes to buying decisions, in the stock market, etc. So what then happened is that then the lenders was expecting bank base rate to go up again. So, and then what was happening then in the bond market, which is basically what banks lend money to each other. So it's all relative to the mortgage market. That's how it's linked. Then started to remove their interest rates. So Nationwide has interest rates on New Year fixed rate will rise by 0.45 points. The following moves to such lenders: Halifax, Santander, Atom Bank have upped their rates by 0.2 this week. Yeah. There's also fewer mortgages on the market for prospective borrowers. According to the financial information company Moneyfacts, there have been a drop of 38 mortgage products across Thursday and Friday. The worst is yet to come, the group said, as other lenders may do the same. When lenders withdraw mortgage products, it can be a reaction on interest rate volatility and even down to demand. However, withdrawals may influence other lenders to follow suit and reconsider their own propositions. The average 2-year fixed rate mortgages are now 5.35 and 5.02 respectively, according to Moneyfacts data. That was literally what you were living last week, right?
Yeah, definitely. I mean, rates are going to come back out. You know, it's a new week. I think we've got to take it week by week at the moment. Rates are going to come back out. Yes, they might be a bit higher, but then potentially, let's wait and see what happens in a couple of weeks. They might still go down slightly, because that's what they do. They push the rates up and then they think, oh, no, hang on. No, that's not right. Let's put them down a little bit, especially if they need more borrowers. That's the way it worked. The more, if you don't want any borrowers, you would increase your rate to stop, obviously, the flow. If you need more borrowers, you reduce the rate to increase the number of people coming to you. So we
can swap, right? So if the client's got an application with a particular lender, let's say nationwide, and then nationwide in the process of the application, and it's with the underwriter or it's at valuation stage, they change their product chance, you can switch it, right?
Well, the product, yes, you
Yeah.
can. Yeah, not with every lender. It's easier
Right.
with some than others, but usually I will always contact the lender and say, listen, the rate has gone down. Can we change it? I did this a few times over the years, and you've got to keep up with it, thinking, okay, well, might as well decline benefit. If the rate's going down slightly, let's do that, because, you know, it takes a phone call or, you know, sometimes a bit longer. But yeah, I always try, obviously, if I can get benefit from the rate for the client, I will do it.
But really, mortgages overall, they haven't changed over the years. That so much of it stays the same. It doesn't really change. It's only while we've got this volatility in the mortgage market in terms of interest rates. This time next year, let's just talk ahead a little bit about rates. So I predict, and this is it's a prediction, right? We talk about you shouldn't really predict it, but who knows what's going to happen. I think bank base rate will go up again next month. Because core inflation is still
this month. You mean this month?
Yeah, this month. Sorry. I don't know if they will put it up again over the summer. They don't tend to do that.
They did last year. They did last year.
Did they?
I was on holiday and a client called me panicking, like, quickly, okay, let's do this. I was, you know, by the pool. I mean, just, yeah, we got there in the end, but yeah, no, they did last year. Yeah, I remember, because yeah,
I've got to be honest, and I do not miss being a mortgage broker. I do not miss it.
It's a lot to think about, for sure. Criteria has changed. They've tightened the criteria. The affordability test has tightened. Yeah, it's. But, you know, it's a challenge, but I do enjoy it.
We do charge a fee, you know, just to mention. I know some brokers don't. 95% do. I know one lady that doesn't. But personally, the amount of effort and work and time that goes into it, and we don't tend to be, we're probably quite here, we're sort of a bit more bespoke, a little bit more hands-on. And that's not to say that others aren't, but because we charge a fee, we don't necessarily have to be doing 20 or 30 applications every month. We tend to try and like maybe only do 10 to 15, just to make sure that we've got time to look after everybody, because it is really, really intense.
Definitely. And also some brokers that I know out there, once they've put the offer out, say, all right, client, I've done everything for you now, you know, get on with it. And yeah, they don't help with the solicitors, where I'm here until they get their key or remortgage is completed, because especially with solicitors now, lately I found that it's a lot more difficult. And I do get clients contacting me, say, oh, my solicitor's not playing ball, or can you support with this? No problem. And here I go and contact you.
I've taught you so well.
So
no,
yeah,
it's lovely to hear, and I know so passionate you are about looking after people. So let's finish the conversation about interest rates and then move on to debt consolidation. So interest rate wise, let's just say we're going to have, it could go up again later on in the year. We're going to argue if it's going to go up over the summer or not. It could happen, it could not. Let's just say bank base rate goes up. So we're thinking it's going to be probably 5.5 by this
next
month.
year, beginning, no, 5.5 will be
by the end of this year.
Yeah, by beginning of next year. Yeah,
beginning of next year. So yeah, and I would probably say it's going to be closer towards the end of this year. It depends on how much the markets react to the core inflation. That is the biggest element. So anybody that's really got a mortgage cut happening in the next sort of 6 months, really, because that's the end of this year, they should be looking to do it way ahead, right? So they can fix something in sooner. And you don't necessarily need to go ahead with it, because you could, like you described before, you can change it. But people moving house, they're obviously, there's a lot of unknown there, especially if they're upgrading and they're taking out more debt. Then it's good to have a chat with somebody like yourself, right? Because you can let them know what to expect of what maybe that interest rate might look like,
yeah,
and if they can afford it or not.
Yeah, definitely. Yeah, no, it's always worth. Sorry, my screen's beeping. Yeah, no, it's always worth, yeah, considering. Look at your options now, like you just said. You don't have to go ahead with it, but at least you're starting to look around, and this is the advice I give. That's the reason why I contact everyone 6 months before, because we know it's not going to happen within 6 months, but it will give us a month to actually lay out, get all the documents, have a talk, see what's going to happen, and then plan from there. So yeah, regardless, yeah, plan now.
Plan ahead, get the documents ready, and have a chat with somebody, and have a chat with Jen, so we can we can be ready and prepared. And if there's something that you've got going on, whether it's like a car loan, or there's a pay rise that's coming, or you can then sort of we can take that into account and say, okay, well, when this happens, this is what your situation will be like, so we can look at the whole picture. So just before we finish up and wrap up for today, let's just talk about debt consolidation. So there may be people that have got those car loans that I described, or they've done some work to the house, or maybe their income dropped over COVID and they took out a loan, or they got debt on their credit card. It might be the cost of living has increased their outgoings and they've put a little bit more on the credit card. Our local big shopping centre is Bluewater. And it doesn't feel like there's been a cost of living crisis based on how many people
does it? No.
Go out shopping. And I just to take the kids to the cinema these days is like a £50 to £100, can't even call that a day out, can you? Because it's just a couple of hours to the cinema. So people might have been overspending. We had a difficult few years. It's not unfair to we use money in such a psychological way to support us. How can the mortgage come into play? So obviously taking out more debt against the property is not always the greatest idea, but some people will need to be able to have a break somehow, right? Interest rates are rising. They might already be in a pickle. What are good circumstances and what are bad circumstances when it comes to when you would or you wouldn't remortgage and debt consolidate?
Well, it would depend on what you're paying now. So if you've got a credit card with 12.1%, I'm just speculating on it, but your mortgage is going to be 4%, although you got to be mindful because you're taking a loan out on a longer term. But if you want to alleviate the monthly repayments, which might be more with your credit card or line or whichever, might be worth considering adding it to the mortgage. It's only going to be maybe let's say £50 extra a month, but it's over a longer term. So it's difficult to predict because every client's circumstances are different. And I think I can't really generalize and say, right, this is what we should do. I would need to look at the case overall, look at the client's circumstances, see what kind of debt they've got, see how we can potentially reduce that debt, see if we could potentially add it to the mortgage, or if not, if it's affordable, with the mortgage alongside it, I would say, right, okay, you're meant to finish. If it's a loan 2 years, you've got 2 years. There's no point, if we can do it, add it to the mortgage. If the lender's going to allow it, pay it off, with your keep your mortgage as it is and pay off your loan separately, because you're going to pay more over the longer term. But sometimes it's not possible. So there's a very fine line of what to do, what's right and wrong. Until you've looked at the whole picture, you can't really plan it, can you?
No, exactly that. And I totally agree. If you've got like 2, maybe 3 years left on a personal loan, then what happens with personal loans, just to explain to people, not to Jen, because Jen knows this, I described earlier on about mortgages being slightly front loaded, but with personal loans, not so much car loans, they're slightly different because some of them have balloon payments. Most loans traditionally are what we call front loaded. So basically all the interest is added first. And then actually, by the time you're 2 or 3 years in, you've cleared all the interest and then you're paying just capital back. So then if you're going to take that debt of a loan and put more interest on it and add it to your mortgage, you're effectively doubling up your interest debt. And what I used to do a lot of debt consolidation is actually not when they have 1 or 2 credit cards. Often you end up saying to them, look, just go and apply for another one. Put them onto 0%.
0%, yeah, definitely.
But organise it, manage it, and increase the monthly amount to, let's just say you get an 18-month 0% fixed rate, and you've got, I don't know, not a huge amount, it might be like 4, 5, 6 grand, something like that kind of figure. Divide that by 18 months and pay it off. Like, imagine it's a loan at 0% finance. That's how you've got to view it, and stop using them.
Yeah.
That's the first step.
That's the best advice. Yeah,
and it doesn't matter what it takes, just stop using them. If it means you have to get a second job, or you have to stop giving your teenagers so much pocket money, like, make other decisions. Don't get more debt. But it's when someone's got maybe 3, 4, 5, 6 credit cards, that's when you get into a spiral, because there's a ratio rule on your credit file, if you get a copy of your credit file, that basically once you've had so many credit cards and the cap of the limit on each of them are maxed out, you'll find it very, very difficult to then get another credit card.
Or a mortgage.
Or a mortgage, yeah. So you don't want to be in a situation where you've got like 6 credit cards all on 18.9% and you can't move them anywhere. You're checkmate. You know, unless you are literally going to win the lottery, borrow a loan from a family member, you know, you've got to think ahead. You can't bury your head. So I used to end up doing a lot of those kind of debt consolidations, which really gave people breathing space to clear those credit cards, not to have much stress, and then actually able to start saving.
So it's the thing is, we've got specialist lenders that deal with that type of circumstances. So the rates are not great, but like you say, breathing space, it helps you set up and start afresh. So yeah, the rate might not be ideal, but you won't have all those extra payments. And in a couple of years' time, although now advice 5-year fix as a minimum, but you know, like I said, it depends. You know, it's not guaranteed what will be best for the client. So until we've looked at it, so I just say, right, 2 years' time, we'll revisit. You'll start afresh. Don't borrow more. Don't get credit card. Cleared everything, and then you can, you know. And you can tell, I mean, the clients I've dealt with doing that, and I keep in touch with them as well. So it's a lot better because you can see the result. Oh, I've done so well. There's somebody WhatsApp saying I'm doing so well. I've cleared that credit card's cleared. Thank you so much. And to me, that's the best feeling, because you know you've done something right. It's about also doing what you're preaching, and I'm like that. I'm very, you know, you've known me for a long time. I'm very sensible with my money. I don't have credit cards. If I can't afford it, I don't buy it. So it's just a case of like, you know, that's what I've done. Whatever you're going to do, it's up to you, but you've got to be very strict, and it's not easy, you know. Like you said, shopping, it makes you feel better, but yeah, sometimes you just go and think, right, do I really need it? Is it a necessity? No. Okay, put it back and just don't
no, exactly that. And if anyone needs any more advice on any of that, there's a chapter in my book about money management, so you can get that on Amazon. If you just search for 10 ways to accelerate your wealth, it's like £14. It'd be a good investment. I get 5-star Amazon reviews. So let's just do a little bit of an extra nugget. Jen, let's talk about 100% mortgages. Tell me what's going on.
Okay, so a couple of weeks ago, no, 3 weeks ago, Skipton came out of the woodworks and said, right, we've got 100% mortgages for first-time buyers. So this mortgage basically is going to use your rent as guidance for your affordability.
It's a brilliant idea.
Well,
common sense, right?
If done properly and sensibly, then yes, I'm all for it. But the reality of it is, it's never going to be that straightforward. So it's not the case of saying, right, I'm going to the bank, 100% mortgage. I've paid my rent for 12 months because it's a 12 months on-time rent minimum over 18, and then let's get a mortgage. So there is a few conditions on that. So you still need to go through affordability. And also, I've got the figures here. So it will match your rent. So if you pay a £500 rent, you can borrow up to 81,000. If you pay a 1,500 monthly rent, you can get up to 244,000. And if you pay 2,000 rent a month, you can get up to 325,000. So potentially, so it's not guaranteed. It still goes through the normal affordability checks and test and everything else criteria. But yeah, so yeah, if done well, I think some of them
for like a small masonette or a flat in some areas of the southeast, but not a family home.
Yeah, I think it'd be better suited for those people. Yeah, definitely. I mean, if you're thinking of getting on a property ladder, like you know, even a young couple, and you've got you looking to buy and you're thinking, okay, we're paying, you know, 1,500 rent. Let's see if we could borrow on the 100% mortgage.
I think it's a really good job for a lot of people. It doesn't make sense how, you know, you can't save enough to get the deposit. You end up living back with your parents, trying to save. but then how do you prove affordability because you've not been paying rent? And so it does, you know, from a credit score, you've not been having any debt, so you haven't got a great credit score. So I think it's just really good common sense.
It is, but you've got to be mindful. So put into perspective. So it's a 5-year fix only.
Right.
It's that mortgage. So can you imagine what the rate is going to be? I haven't got a rate at hand at the moment, but if you,
it's going to be quite expensive.
It is, but if you manage to have a 5% deposit, the rate will go down and you'll be paying. So let's say with Skipton, your rate is going to be 5.05. I'm just speculating, it's not that, but and then if you get a 5% deposit, your rate is going to be 4.80, let's say. So it's always worth, so it will be good in very difficult situation where you've got no other options, and you know it's a good option for you to look at. But if you can just save a little bit more, even if it's 5%, it's always worth looking into as well. So
also, you still have to pay stamp duty, right?
As well. Well, it depends on the property value. So yeah, you've got allowed for that as well. Yeah, potentially.
Yeah. How much is it exempt up to? What level?
It's 250 was, I think. Oh, I'll have to double check that. I've got a blank. Yeah, I think it's 250.
I think you're right. I think it's 250.
Yeah, it starts at 250.
If you're borrowing like the 244 like level that you mentioned, then that would be all right.
Yeah.
Brilliant. Great little tip there, Jen. Thank you so much for joining me today, Jen. I'm so glad I got you on. I've had this podcast for almost 2 years, and I don't know why you've not been on. And I'd like you to come back on next time. We'll get it arranged maybe for 2 or 3 weeks' time to talk about estate planning and wills. It's a really, really important subject. So anything you'd like to leave to say before you go today?
No, thank you for having me on. Yeah, it was nice to just put it out there, what's going on, and keep up with the news and letting people know. Yeah, no, really good. Thank you.
More than welcome. And so we're over and out from me.
Bye.
I hope you enjoyed today's show. Do leave a review on whatever platform you're using. Do let me know, message me and let me know what you thought of our show today, and I'll pass on any comments to Jen. Love you to leave a review, and please let me know when you've left the review because it doesn't notify me and I forget to go look, to be quite frank. But I do always enjoy hearing when people have enjoyed the show. It's over from me and it's over from Jen, and I hope you have a wonderful weekend. Take care.
Bye.
Thank you for joining us on today's episode of Accelerate Your Wealth. For further help or to connect with Rebecca directly, please head over to the website www.rebeccarobertson.co.uk, where you can find further information on our planner, book, and how to further maximise your wealth. Our sponsor, Evolution Financial Planning, for regulated advice on pensions, investments, mortgages, insurances on www.evolutionfinancialplanning.co.uk/podcast.